In the world of trading, there are strategies everyone talks about, and then there are strategies hedge funds quietly rely on. One of those strategies is delta hedging, a tool that separates professional market makers from retail traders. Today, we're going to break down what delta hedging really is, why hedge funds depend on it, and how understanding it can change the way you look at derivatives markets forever. Welcome to Derivatives Trading Mentorship, where we give you access to the advanced professional data and proprietary calculations that banks and hedge funds actually use behind the scenes. If you want to learn more or even access our hedging levels directly, you can visit us at www.derivativestrading.com. What is delta hedging? Most traders hear the word hedge and think it's just about reducing risk. But in reality, delta hedging is about balance. When you hold an option, its value changes with the price of the underlying asset. That sensitivity to price change is called the delta. For example, a call option with a delta of 0.5 means that for every $1 the stock moves, the option gains or loses about 50 cents. If you own 100 options with a delta of 0.5, you effectively control 50 shares of the underlying asset. Now here's the problem. Markets never sit still, deltas shift constantly. If you're holding options, your exposure is always moving against you. That's where delta hedging comes in. By dynamically adjusting your position in the underlying asset, you neutralize that exposure. In short, you become delta neutral, meaning no matter where the market ticks, your portfolio stays balanced. Why hedge funds depend on it? This is not theory. For hedge funds, delta hedging is survival. If you're a market maker, every trade you quote to a client leaves you with risk. Someone buys a call from you, you're now short that call. Without hedging, a single sharp move in the underlying could wipe out millions in seconds. So hedge funds and banks use delta hedging to stay protected. By offsetting exposure with underlying shares, futures, or even other options, they control risk with precision. And it doesn't stop at delta. Professional desks also monitor gamma, the rate of change of delta, because even a perfect hedge won't stay perfect for long. That's why our mentorship and our proprietary data don't just give you delta levels, we calculate gamma hedging levels too, so you can see where real market makers are positioned. The hidden advantage of delta hedging. Here's the part most retail traders never realize. Delta hedging isn't just a shield, it's also a weapon. When you hedge properly, you unlock strategies that generate consistent returns regardless of direction. Hedge funds use this not only to survive but to profit in all market conditions. Imagine this. While most traders are betting on whether the market will go up or down, hedge funds are making money simply from the movement itself. That's the quiet power of professional hedging. How you can apply this? Now, you may not be running a billion-dollar book like a hedge fund, but you can still apply the principles. Learn to think in terms of exposure, not just price. Understand where your delta risk lies and how to neutralize it. Pay attention to gamma levels, because that's where volatility can either destroy or protect your portfolio. At Derivatives Trading Mentorship, we've built tools and proprietary data that calculate these levels for you, the same type of data hedge funds are using right now. If you want access, visit us at www.derivativestrading.com. The takeaway: delta hedging is not about chasing the next hot trade. It's about professional risk management. It's about trading like the institutions, not against them. When you understand delta, gamma, and the mechanics of hedging, you stop playing a guessing game. You start trading with structure, with discipline, and with the same framework banks and hedge funds rely on. That's what we teach here at Derivatives Trading Mentorship. If you found this breakdown helpful, make sure you subscribe for more strategies straight from the world of professional market making. And don't forget, if you want deeper access to our proprietary calculations and hedging levels, you'll find it at www.derivativestrading.com. Thanks for watching, and remember, in trading it's not about predicting the market. It's about mastering the structure behind it.